Welcome back to another FOMC press conference. I'm coming to you from Canada. I've got a little bit of leftover Timmy's, and I'm super excited to be bringing you the press conference while on my vacation in Canada because I actually really love this. This is really exciting. And don't worry, we'll have plenty of time to play the rest of the day. Now, today, we have to focus on Jay Powell. And why is he wanting to keep everything hawkish and aggressive and angry, it seems, or frustratingly hawkish, even though numbers are coming in solidly? After all, it seems like CPI is coming in and trending down. We've got CPI meeting expectations yesterday with Supercore falling roughly in line of where you would expect the Federal Reserve would want it, at least in terms of its direction. We're not as low as we need to get yet. And then, of course, you've got PPI this morning that's turning nearly outright deflationary. In fact, Elon Musk this morning tweeted, deflation is coming. So what is the Fed up to, and are they potentially missing something? Or is this all what we're about to see, a charade to make sure inflation expectations are normalized, or should I say stable, since they are already potentially in the direction of normalized? We shall see. But for the moment, let's go ahead and, let's see here. Let's get ready. Okay, yeah. So Jay Powell's press conference comes out in about 4 minutes. 4 minutes to the Jay Powell press conference. I'm going to try, just for giggles, once again to allow Twitter to have access to this, but usually that does not work. Even though I pay for their little yellow check mark, I can't even get Twitter to function on any of my devices, which is pretty crazy. But let's see if it works this time. Nope, this space is not available. Still can't do it. I guess we'll stick on YouTube. Sucks for them. Or is the joke on me? I don't know. But we'll find out what we have. We'll have the... we'll be tracking the Fed decision with Wall Street as well. And then, of course, we'll be streaming Jay Powell to find out exactly what the details are of this report. And let's see what we've got. In the meantime, we have stocks that somewhat softened a little bit heading into this. Dow's down 46 basis points, S&P up 13, Nasdaq's only up 14. You've seen these all a lot higher, and you're seeing that softening going into the meeting as we expect a hawkish Fed to some extent. You're looking at bonds and oil rotating down as well. 10-year down about 6 basis points. Oil down about 45 basis points, though oil did rise going into this, mostly because of the stimulus coming to China. Now, some people actually refer to China as like a bearish thing for the United States economy, that, Chinese orders slowing down is some kind of recessionary indicator. It's an indicator that the Chinese reopening just wasn't as well funded, should we say, as the American economy. And so it makes sense we're going through this adjustment period. But anyway, 2-year Treasury is also down about 6 basis points. So you kind of have an equal decline there in the 2 and 10. So the inverted yield curve element, the spread between the two, remaining about the same. We are now about 3 minutes away from the FOMC press statement. That'll be pretty big. You've got BTC still sitting at that resistance of about 26,000. Ethereum sitting at 1,738. Maybe one day these will start moving again. My guess is you're really not going to expect major movements here until you actually get the some form of regulation at this point. Let's listen in here. I want to make sure you could hear this. So let me know if you could hear this tab, if you wouldn't mind.
5% area.
We're good here.
The economy seems to be doing just fine. Job growth.
There we go.
And look, stock market is up 22%. Like in my book, that is not the sign of a market that's worried about like a really vice-like grip coming from the Fed.
And you look at the regular CPI, including energy, and you look at energy, and it was one of the main reasons that number came down as much as it did.
Right. So I think people might be getting a bit of a head fake. It's great that the overall inflation rate's down from 9 to 4%, but we know from years of covering this that the underlying trend is better arrived at by getting rid of the food and energy components. That gives you 5%. Now, take out some of the other stuff that's a little funky, like shelter, cars, and so forth. You end up with something that's we're calling supercore, and that's like running at 4 or 5%. And none of those numbers are anywhere remotely close to what the Fed wants, 2%. So that's why I think that there's a bit of a reality check in order.
Michael Kushma, give us your setup here with 2 minutes to go quickly. Sure, I think there's a good case. I think 60-40 that they pause, or I should say skip. Skipping me. I think skipping is different than pausing. Pausing may mean they're stopping. Skipping means we're still in the process of raising rates, but we've done enough. Let's take a pause and see how things are playing out. Inflation has come down a lot, as Greg said, but on the other hand, major components of it are not decelerating very fast. And if you compare today's data with what they were projecting back in March, the last time they put together their projections, inflation's higher than expected, unemployment's lower than expected.
Okie dokie, mister. Remember that last time in the last CPI report, we had strong transportation. And what did PPI actually show today? Huge deceleration in leading indicators for transportation costs. So I wish he would give us some examples of these categories that he's suggesting are somehow getting worse. We're really not seeing that. It's a bumpy ride. It's not straight, but I don't know here. Yeah, you got a little bit too much bearishness going on over there. Get this guy off the screen. Look, I'm all for very different opinions, but come on. All right, folks, we are now about 10 seconds away. Again, if you have different opinions, at least provide the data. All right, the first thing I'm going to read off is what ends up happening with rates. We are expecting it to be a pause. Then we're going to go into what Wall Street is saying and what the statement is. And we have a pause. It is in. We have a pause. We are at a pause. This is the first time we've paused since the hiking cycle began. The hiking cycle began quite a while ago in March of 2022. It is over. It is over. The Fed's hikes are done. And as I suspected, the vote was unanimous. The Fed does not want to send any kind of dissension at this point. The vote was completely unanimous. That's fantastic. Okay, let's see here. Downloading the PDF on the press statement right now. Unanimous vote. That's really good news. The Fed says to the extent of additional firming will hinge on the economy. Oh, okay. I don't like that. That's really bad, though. The SEP raises the guide to 5.6. I suggested anything over 5.5 would be bearish. 4.6 to the end of 2024. That forecast not good. I do not like that forecast, though. That's bad. Again, I was looking for a 5.3. Anything over 5.6 I thought was bearish. So what do we have here? U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses will likely weigh on economic activity, hiring, and inflation. The extent of these effects remain uncertain. The committee remains highly attentive to inflation risks. Okay, we know this. There's the holding the target steady at this meeting. This meeting, they specify this meeting, allows the committee to assess additional information and its implications for monetary policy, the extent of which additional policy firming that may be appropriate to return to 2% over time. The committee will determine or we'll look into the account of the cumulative tightening of monetary policy, the lags. This is all the same. In addition, looks like they put two spaces there. In addition, the committee will continue reducing its holdings of treasuries. They're doing two spaces on everything. Okay, that's no surprise. Okay, so this meeting, they're trying to make it clear that this is this meeting pause right here. That 5.6, though, on that summary of economic projections, I'm not happy about that 5.6. I want to get that summary of economic projections up here as soon as possible, but that's not fantastic in my opinion. I would like to see those. Okay, I got the SEP. I'd like to see that a little softer, but it is what it is. And so that is tighter because that potentially prices in 2 more rate hikes by the end of this year, folks. 2 more hikes by the end of this year. Yeah, there it is. Look at that revision to 5.6. I was really looking for a 5.1 when we went through it this morning. I think it was, where was it? I have it here somewhere. Here, this is my, that's the course pitch for the courses linked down below in the phases of price increases. First price increase this Friday. Here's my pitch. So let's compare this. My pitch was 5.5 sad face, 5.3 somewhat happy face. We ended up getting 5.6. Not happy about that. What else did we suggest? We said that, where did I put the, oh, there it is. Okay, we said that this would probably go up. I suggested GDP would probably go up, and I wrote markets next to it. The reason I wrote markets next to it is because the market likes it when we avoid a recession. And so a higher GDP is good. What did we get? We got, ooh, look at that. That's a 1%. That's actually very good. That's why you're getting that higher projection on 5.6, because real GDP forecast is higher from the Fed. They did lower 2024 by 1 basis point, and they lowered 2025 by 1 basis point. So this is a really big push over here. I like to see this. So we went plus 60 basis points, minus 10 basis points, minus 10 basis points here. The unemployment rate, I said we would see. Oh my gosh, look at that. I nailed it. I said the unemployment rate would go to 4.1, then 4.3, 4.3. We got 4.1, 4.5, 4.5. So they did nail this. So I got one thing right. At least that makes me happy. But that's a good sign because we've actually seen that. And I like seeing the Fed adjust those numbers based on what we're actually seeing. So we know they're with us here. Are they all with us? All right, we've got core PCE inflation projection sitting at 3.6. That's a 10 basis point increase from the last one. What do we have in this one? They actually take core PCE and drop it. No, I'm sorry. No. They raise it 30 basis points here. And headline, what do? They take that 3.1 versus 3.1 we've seen in December. And then we go to this one. We get 3.3 going to 3.2. So they drop. Stand by. 3. Yep. Okay. They drop PCE inflation 10 points, but they give 30 to core. So they're indicating that core is still running a little bit hotter than they had expected. However, I'll tell you that pain point right there is that number you see right there, that 5.6 in pink. That is substantially higher than I was expecting. I was looking for 5.3, maybe 5.4 because it would price in one more rate hike. Nope, sorry, this prices in 2 more rate hikes. It's not great. That's an adjustment for the markets. Now, adjustments have been known to sort of overweight this section, though, but that came as a surprise. And so the NASDAQ has rotated down. We've lost on the QQQ. We've lost about 2.5 points. That brings us down about 1/3% rather than 0.5% up where we were. Tesla, for example, was positive, is now down about 2%. NVIDIA was at about 420. We're at about 416 now. So, okay, let's look at the dot plot. So my prediction for the dot plot's probably going to be low then. The old dot plot was right here that I revised, showing a concentration up with a removal of the top and bottom. Let's see what we ended up getting on the dots. Okay, there we go. We have a concentration. Oh, wow. But look at where that concentration is. Oh, wow. They are really trying to signal that they are not done is what they're trying to signal. That is a 5.6 with the dot plot over here. You have 5 looking at below. So 5 of them sitting around. You've got maybe 2 here. What is that? Let's draw this out. You've got maybe 2 at a pause, right? And then you've got everyone else here at a hike. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Yeah, 16, 18. It adds up correctly. 16 sitting at least one more hike. And then you do have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 pricing in a potential for 2 more hikes. So of course, this being the same bundle right here. So 12 of the 16 pricing in 2 more hikes. A little aggressive over here. It also looks like they've moved up some of these projections on the right dot plot. Let's go to the right dot plot. That's this is the last assessment. Yeah, you could see the median was really sitting around that 4.1 level over here, maybe 4.5 at the high here, and here we've completely gotten rid of the 4.1 almost, with the exception of 1. You're sitting a little higher here. Looks like a 4.4-ish, which we could see the actual calculus here. And then let's look at some of the ranges as well. Remember, Jay Powell will be coming out to speak in about 23 minutes, so we'll be covering the press conference live. Okay, so here we have 1.1 in the change in real GDP. That's fine. Where is our dot plot? Here we go. So we're going to look for the range of the dot plot. Wow, look at the range forecast. The range forecast, nobody is forecasting a cut for 2022. It's kind of like how Kevin is not forecasting a cut for these programs on building your wealth. In fact, we have 4 phases of price increases coming up. Now, they're on screen here, so I won't talk about them, but basically more lectures are coming, and we have 4 phases coming up. The first one expires on the 16th. Check that out, link down below. You get access to me every morning in our fundamental analysis live streams where we look at things like Ubiquity or Intel or Open Door before it doubled or Tesla, whatever. Okay, we got SoFi coming up probably tomorrow. So what do we got here? We've got this range is pretty high. That's a no cuts range. Let's write that down. No cuts range right here. That's a revision from the last one, slightly up. What do we have for GDP? Is anybody looking at recession? No, the recession has been removed. 2023. The recession has been removed. You could see in the last forecast, there were some Fed individuals who were looking at a recession, showing a GDP going negative in 2023. That has now been completely removed from the estimate, keeping the Fed hotter. That's what you've got here. You've got a Fed hotter. Next year, we're looking at a revision up with a base here of 0.5 in GDP. The Fed really thinks they can orchestrate this soft landing, this no recession. And as a result, you've got this potential that they will actually hike again. This should absolutely move some of the expectations that we're seeing in the Fed rate monitor. This morning, we were sitting at about a 50. We were down after PPI. We're down to about a 59% chance of a rate hike in July. I would expect that's probably going to shoot up to about 70% now. It's actually not updated yet. Excuse me. Give it about another 6 minutes or so. Usually they take about 15 minutes for some of that data to actually come through. I want to look quickly at what some of the Fed is saying here. We've got now we're seeing a sell-off, S&P down 0.7 now. Remember, this is just the first of a four-day rally in a couple months. First four-day rally in a couple months, so keep that context in mind. There's going to be an even greater scrutiny on key monthly releases, such as jobs and inflation going forward. Great. Yeah, to determine whether we're going to start rehiking again. Interest rate futures aren't trading in line with projections. The year-end implied rate is, is only 5.1%. The Fed thinks it's going to be 5.6. That's interesting. Pun intended. Okay, so in other words, the futures market, the bond market, what's the bond market telling us? They're telling us we're looking at a terminal 5.1%. Now, remember, this morning I talked about observing that the peak is actually looking like it's going to be in September. Let's write that somewhere else. Let's write that over here. So we're looking at a September peak. Oopsies. Sorry, I lost the screen there for a second. That's my fault. I unplugged the darn thing. There we go. We're looking at a September peak now, with potentially that the highest terminal rate being in September. That allows us to have this pause in June and then assess the economy for July, August. We will not have a Fed meeting in August, but we'll be able to assess, potentially maintain the pause in July, and you could still get a hike in September, November, or December. So maybe what we'll get from JPOW today is talk about patience, that we'll stay paused until we feel like we have to hike again. It is not a foregone conclusion that July is going to be a hike, that this is a pause for just 30 days. It is possible the Fed is actually going to try to target another hike here in September. If they target a September hike, we might maintain this pause through August and then look at another hike when we actually have data for the second or for the last quarter of the year. This is going to be something that we're going to parse in the data from Jerome Powell today as he speaks in just 18 minutes. You do have Treasury yields jumping a bit after this. The 10-year Treasury yield has given up almost its entire 6 basis point collapse. Now it's actually only down about 1 basis point. The 2-year Treasury yield completely flipped from about a 6 basis point decline to a 5 basis point rise. So we have just seen a further inversion. More inversion has just occurred. The bond market is pricing in that the Fed has gone too far, and that is reiterated by more inversion being priced in immediately. The markets immediately priced in more inversion when they saw the Fed become this hawkish. Now, remember, we were expecting this number to go up, and we were expecting GDP to go up and unemployment to go down. We were expecting these. We got a lot of what we were expecting. The problem is we ended up getting a much higher result here for 2023 than we were expecting. This number, we knew it was going up. We were directionally correct. Unfortunately, the magnitude a lot higher here than we were expecting. Some people referring to this as a healthy pullback. Some folks suggesting, hey, this is okay. This is just a little bit of give back off of the bullishness that we've had over the last few days. Absolutely true. And Jerome Powell could talk this down. We don't know, but Jerome Powell could be one of those lower dots, and he could be the one driving the ship here with a lower dot suggesting, you know what? Personally, I actually think we might be there. We might not have to keep going, but there are other members of the board who think we have to keep going. And out of respect for them, hey, that's just the average. Remember, even though technically they don't collude on this number, I kind of think they do. They're going to tell us that, oh, we don't collude on that number. We just all wrote down what we think we're going to be at the end of the year, and the average just happened to be 5.6. Don't read into it so much, Kevin. I'm going to be thinking bullcrap. But this is okay. In my opinion, as we talked about this morning, sorry, I put that screenshot in here. I talked about this being clickbait because of 3 reasons the Fed should pause. I talked about the Fed should pause and stay paused because wages are rotating down. Wage growth is rotating down. I also talked about CPI Supercore and PPI coming down. We also, as A is asking here, A in the chat is asking, Kevin, doesn't this ruin the Fed's credibility, like you mentioned? It potentially absolutely could. That would be one of my concerns if I were a Fed member, because what does history tell us? History tells us stay away from pausing and then hiking again. It's a stupid idea. So for those 3 reasons, you should not expect the Fed to very quickly return to hiking. It would once again lead people to question the Fed's credibility. However, why did we call it potentially clickbait coming? We called it clickbait coming because the Fed has to talk dirty to us. The Fed has to do this to us. They have to talk dirty to us to keep inflation expectations anchored. We made that very clear, and that is an expectation that I think holds. Oh, take a look at this. This is perfect timing. One of the designers just sent me this. Oh, that's beautiful. Look at that. Price increases on each course. And we actually show the phases here. June 16th you have in there. Oh, that's really nice. I like that. They did a really good job on that design. I like the little timer thing too. Anyway, I don't know why I'm talking about that. Oh, look, they did a little banner too. Oh, that's really nice too. It's like a menu that shows you how the courses were. Oh, that's very sexy. Anyway, okay. So let's for a moment reconcile here what we have coming up. So we've got JPOW coming up in 15 minutes. What are we going to listen to for JPOW? First of all, the most important thing I believe for Jerome Powell is we want to hear him tell us that, hey, look, those are not my projections. Those are just everybody throwing the darts against the board, okay? So that's what I want to hear. So number one thing I'm going to be looking for is distancing himself from the dot plot. I would love to hear that. That would be very good. Why would that be good? Because Jerome Powell is driving unanimity. I can never say that. I'm trying to type it too. I spelled it wrong anyway. And it's not that hard to spell. It's IT. Anyway, okay. So distancing himself from the dot plot is the first thing that we want to see. The second thing that we want to hear is we want to hear Jerome Powell reiterate that rates are restrictive. That's what we want to hear. Third, we want to hear that a recession is no longer a base case. Remember how Jerome Powell previously said, hey, like it actually looks like we might slip into a recession? I want to hear him flip-flop. I want to see J. Powell flip-flop so badly. It would make me feel so good to see him just one little flippy-dippity. Anyway, we want to see him flip-flop on this idea that a recession is the base case. What we want to hear J. Powell suggest is that a recession is actually no longer the base case, that we think we can avoid a recession almost entirely. That's what we're looking for. I just realized the one thing that's missing on this banner is it doesn't say email staff@meetkevin.com if you have questions or bundle requests. But anyway, that's a very interesting. I like the menu a lot. Look, we even did a big menu like this. See, look at that. You can kind of see there's the investing courses, the real estate ones, the stocks, and that's interesting. Okay, anyway, so the fourth thing that we want to see Jerome Powell talk about is wages. Wages. What are wages going to do going forward, given that they're still on the path of plummeting? And if wages are on the path to plummeting, then why are we potentially suggesting that we need more hikes? Why? That would be the big question for me. Wage growth is plummeting. It is ridiculous that to now suggest that we need to continue to potentially hike 2 more times. But then again, that's what we're seeing here. So I would like to see some commentary around wages from Jerome Powell, and we'll get all of this within the next 12 minutes. We are now 12 minutes away from J. Powell, and I have some questions for him. I wish I was over at one of these meetings so I can actually ask my questions instead of sometimes the stupid questions that we end up getting. But, you can't always get what you want, I suppose. This is right here the Federal Reserve's change in statement. So the document that just highlights the changes. You can see again, we saw a lot of this already. Recent indicators suggest that economic activity has continued to expand rather than economic activity expanded at a modest pace in the first quarter. They changed that to recent indicators suggest economic activity has continued to expand. They have also argued for maintaining the target rate as well as holding the target rate steady at this meeting to assess additional information. I really think this is an assessment going all the way forward to September. So it wouldn't surprise me actually to see the interest rate probabilities for July stay stable and September skyrocket. Yes. No. Right now we've got about a 59.5% chance of a 25 basis point hike in July and a 58.4% percent chance of a hike of 25 BP by September to the 5.25 level. Let's take a look at the 5-year break evens because we've had some large movement in the treasuries market here. So let's look at that. I do also potentially want to take a moment to look at short interest. Again, we haven't done that in a high period of time, but let's look at and a lot of shorts going into this press conference. Remember, you've got massive options expirations coming Friday, so expect a lot of volatility this week. You've got, another witching here. Okay, so the 5-year break even after this hike projection from the Federal Reserve is going to put you at 2.17. I think that's the bond market feeling like, oh, Fed, are you seeing something that we're not seeing? Okay, so then we're going to look at the short interest database. I have the S3 Partners short interest database. We can put any ticker in and we'll get some short numbers. Waiting for that to load up. That just takes a moment to load up. It does look like the S&P and the NASDAQ are maintaining their sell down at roughly about 30 to 40 basis points. Tesla's still down 2. NVIDIA is actually holding on to green today. You've got a lot of new ETFs, it looks like, that have options out now. A lot of talk about those. And then it looks like we have that. Here we go. We're getting that short interest data slowly driving up. It is taking a little bit longer to run. Maybe if I had a Dell, it would be up by now. Whatever. I'll work on getting that up. In the meantime, let's take a brief listen to CNBC. Keep in mind, Jay Powell is going to be here or live, rather. He's not going to be in this room in Canada, but he is going to be live in now just 9 minutes. Remember, I want you to write down the 4 things that we want to pay attention to. I mean, obviously, you could do whatever you want, but I'd highly recommend you write down these 4 things. Write down the following. Number 1, is Jerome Powell going to distance himself from the dot plot? He drives unanimity. Big deal. Are rates sufficiently restrictive? Is a recession still a base case? And what's going on with wages? Let's listen now to CNBC. There you go. Okay, let me get a little bit more Wall Street commentary. This is a little bit boring, but I agree with the person about Intel who is just complaining about Intel's valuation. But we'll see. Could end up being a value trap, so you have to be careful. Okay, so what do we have here? We have Wall Street talking about this potentially putting Jerome Powell in an awkward position. It potentially puts him in an awkward position because they expect that he might be one of those people looking at a pause forever. So we'll see. B of A tells Bloomberg TV that they should have hiked today, but I think they got stuck on timing. The market pricing wasn't where they wanted it. Well, of course it wasn't, because they sent like 27 different signals that they were going to pause today. So no, I think you're wrong, B of A. They had plenty of opportunities. Well, one Nick T piece, and we would have had a hike priced in today. That's all it took. Given that the FOMC is penciling in 2 more rate hikes, Powell may have a little bit of awkwardness explaining why the committee didn't go ahead with a move today. Agreed. Is the idea hikes every other meeting? Are we waiting for banking issues to go away? Is it something else? Remember, the Bank Term Funding Facility has actually still been trending up a little bit in its usage. So it's still signaling some underlying stress or desire for liquidity for smaller banks. And that's not to be confused with this liquidity crisis people keep talking about with the Treasury General account. Total bullcrap. The reverse repo facility basically fell by exactly the same amount as the Treasury General account filled back up. And I expect that to continue. $2 trillion of excess cash sitting around there. Upgrade to the Fed's growth forecast for the year is an additive to outlook, in the sense that it's not growth being pulled forward from the future. The 2024 GDP forecast is set for a 1.1% gain, little changed from the 1.2% they previously projected. Right. We saw basically a plus 30%, 30 basis points this year and minus 10 basis points this or next year, which is a sign that, well, these Wall Street's basically trying to say we're not pulling everything forward, only a tiny little bit, only 10 basis points. The other 20 are just straight because we're actually growing more. Notable upgrade to the growth forecast, right, from 0.4 to 1%. Absolutely. That's a big deal. Talked about that as well. Big deal there on the SEP. You've got the explanation for why. That's the big question. Why is the dot plot saying 5.6? And if Jerome Powell explains that away, this market will rally into the close. So be prepared. If you're trading this, I would be prepared and very, very closely listening to Jerome Powell explaining away that 5%. If he doesn't explain away the 5%, or he doubles down on that 5.6%, that's bearish, right? So if you are a trader right now, I would be looking for the phrases base case recession, distancing himself from the dot plot, are rates restrictive, like you said in the last two meetings they were, and are wages driving inflation, or are you maintaining the flip-flop that y'all had in the last meeting, which was this flip-flop away from the importance of wages driving inflation? In other words, you don't need to cause as much unemployment, which is why you've reduced some of those unemployment expectations for the SEP. So, and are we also looking for September instead of what we had previously, which was the implication that there would be a July hike? I would like to hear the phrase from Jerome Powell, we're going to hold for one or a few meetings. If I were him, I would use that phraseology. I would say we'd consider holding for one or a few meetings as the data comes in. And then the market will understand that. They'll say, okay, so basically you're willing to wait until September. Because if you wait until September, what does that mean? Well, you wait until September, it actually suggests that you could have 3 months of being paused. And then much like the Bank of Canada, you paused for, Bank of Canada paused 4 months and then they hiked again. Maybe you pause for 3 months and then hike again, right? So I'd like to see some color on that, without a doubt, color on this. How many meetings would we pause for? That'll be a big deal. By the way, I'm using this new little webcam, which I know streaming doesn't always show all the quality, but I've got a sponsorship with this new webcam, which is so amazing. If you go to metkevin.com/webcam, you can see it. Follows me around. The quality is amazing. If I set it to 4K, I've only got it at 720 right now, but it's by far the best webcam I've seen so far. So check that out by going to metkevin.com/webcam, or get those free stocks at Webull by going to metkevin.com/free. 12 free stocks, and you'll sign up for what Webull is up to. Now, let's take a look. We've got about 3 minutes here before we get Jerome Powell's press conference. Let's do a quick look of the markets while we wait. Remember, again, if you are a trader, watch for those 4 things and some of those phrases we talked about. If you missed that, just scroll back over the last 2 minutes and get that explanation. You can see a lot of things have gone red here. Open Door hit my target of $3, basically. It was up at like $3.99-ish or something like that earlier today. I can't remember exactly. Wait, well, here's the high. It says the high on Webull. No, I'd have to. Oh, sorry. This is the minute high. I'd have to go to the day high. That's fine. But anyway, forget about Open Door for a moment. We can analyze Open Door separately. So we've got Apple's down 0.5%. That's absolutely going to weigh on the S&P 500, the NASDAQ. You've got a decline on Matterport. Matterport was up 10% in the day on this nonsense announcement that they were introducing generative AI. Generative AI that, by the way, already exists. But now all of a sudden they're suggesting, oh, yeah, we'll have it, don't worry, by the end of the year. I'm like, that's pretty weak. You actually have Target moving today. They've been pretty beat up. Intel, another pretty beat up play, also moving today. Tesla, which is about to break its 14 days of rallying, down 2%. SMCI was up as much as 3-4% this morning. It crashed. We actually did a fundamental analysis on SMCI this morning, and let's just say it was very enlightening. Remember, if you join the courses, you get lifetime access to all of those fundamental analyses and the history of them, and what we think are risk factors and benefits. You've got Bill.com down 4%. You've actually got Redfin sitting at that $10 level, which is great. It's grown up nicely. I mean, look at that. It was $3 back in October, but it's really recovered, especially as the real estate market has started to recover. Problem is, you still lack volume for real estate, even though home prices have started to trend up again. So Enphase down another 1%. So a lot of tenuousness right now waiting for Jerome Powell. And we're not getting a lot of recovery going into the meeting. Often we get recovery going into the meeting after the statement. We did not actually get that this time. If you look over here on the right, you can see obviously a massive uptick in volume and selling pressure. We got a slight recovery, but we kind of gave that up again. So we're really tenuous about, I think the market's looking at this going, J-Pow, what the hell? What is this 5.6? This is odd. This is strange. So I think that's a consideration here. We'll pay attention to this, obviously. Next up, oh, hey, Jack, I can see literally just your legs. That's kind of funny. There, give us a wave, Jack. Give us a wave. The other side. Like, yeah, there you go. Now I can see your hand. Okay, anyway, so J-Pow's going to be out momentarily here, so let's go ahead and jump on over for the countdown to J-Pow. Remember, folks, email us at staff@meetkevin.com if you want to bundle up on any of those programs on building your wealth. Take a screenshot of the schedule for price increases. First price increase coming here on June 16th, and that's basically like a free month if you use Buy Now, Pay Later. All right, let's listen in.
Market is going to fully buy into this new outlook for the Fed, but I'd be shocked if they didn't at least push out the date when they start to see the long hope for
maybe
rate
before
cuts.
we go to the chair, we could just put up where the markets
Means the
stand
chair's
right
not out
now,
yet.
the S&P, the Dow, and the
Come on.
NASDAQ.
He's always on time.
Just as a marker, and then maybe look at bond yields if possible. So there you see more red than we saw when we began this about 90 minutes ago. The industrial's down nearly 400 points, NASDAQ off 0.5%, the same with the S&P 500. Bond yields, there you go. There are treasuries. And you see the 2-year and the 5-year. You still got a pretty seriously inverted yield curve.
Oh, yeah. And the 10-year has backed off. I mean, it was at 380.
That's the thing. You had more of an inversion. When I pause it like that, do you hear the pause? Just let me know if that audio sounds okay. So we should get J-Pow here in just a moment.
You, Greg, think people need to listen to this whole press conference? Sometimes it gets really interesting towards the end.
That's right. Yeah. Listen to the very end. You know, some interesting questions come along then. It's like, for Fed heads like me, it's like the best 1 hour of television.
And here is J-Pow. Thank you, Greg.
Thank you.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
Increases.
And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the consumer price index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year.
No.
But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right. Obviously, up to 2 rate hikes is going to be quite interesting, but let's see how he answers this now. This is the big part.
Curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were.
Say rates are restrictive.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, 2 things. 1, decision hasn't been made. 2, I do expect that it will be a live meeting.
I'm bummed he's not talking about rates being restrictive anymore. He's kind of walking off that by leaving that door open now. Like maybe we're not restrictive yet. Who knows?
I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots.
Yeah.
stronger GDP, less of a hit to unemployment, slower progress on inflation. And I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand is not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And, I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick. Oh, Nick T. Here we go.
Nick Timmeros of the Wall Street Journal. What's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences.
Honestly, he's talking about going to September, in my opinion. Banking crisis he's talking about now.
The extent is we'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina. Thanks for taking our questions. Gina Smiley, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, and marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate? Or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
Do you think it's possible?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
He was literally so passive on this idea of what's going to happen in the future. He's kind of like, I feel like he's like, I don't agree with this, but I'm just here to say it. Like, we're pausing. I don't know what else.
We're getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously, the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where's sufficiently restrictive?
Yes, such a good question.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year. And I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, with more data over time.
He just undid what he said last time, which was we were at sufficiently restrictive. He just undid that, unfortunately.
Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy. We're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. By taking a little more time, we won't go well past the level where we need to go.
I think people twisted his arm at this meeting.
Credit tightening since the bank incidents from March, and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Quick reminder, we're 2 days away from coupon code expiration for phase 1 price increases. That's Friday night.
That many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months.
Yep.
And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really moving down. We want to see it moving down decisively. That's all. of course, we are going to get inflation down to 2% over time. We don't want to do, we want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. So hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver.
Here it is.
But you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point?
It's number 4 on our punch card.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. But that was the origin, and it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Let's go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You all a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to? Time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move on. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%. And the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
He seems fussy today, like somebody has a gun to his head. Like it doesn't seem like himself. He's frustrated.
With Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that and then go back to the balance sheet. So on that, Of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately.
Yes.
So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation. And I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now. And that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast. And then they send it in on Friday afternoon and we accumulate it and then we publish it for you.
There's the distancing.
So
You just did it.
that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
This distance. That was great. That's bullish.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be 2.8 trillion in 10 years. The CBO also says that federal debt will be 52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
You know, I would just say it this way, that I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market is that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is though simply this. We see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%.
Okay.
And we'll do whatever it takes to get it down to 2% over time. That is our plan. And you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy. And you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down. That probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate.
He's confident on that.
Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
I ran a poll as well if you want to vote. Is it bearish? Is this meeting bearish or bullish? What do you think? Vote.
Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in Black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about there are longstanding differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal, and so we do watch that. But remember, all unemployment, including Black unemployment, has been bouncing around right near historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
He's so done.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how I'll back up. We haven't quite seen the slowdown in rents show up in CPI yet. And we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming, or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, as a factual matter, that's correct. We do need to see, rents bottom out here, or at least stay quite low in terms of their increases, because we want the, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important. And so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, a year. You're just not seeing a lot of progress, not the kind of progress we want to see. And it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again. And we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services, excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So we what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. 3%. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Okay.
Yeah, okay. Great.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very labor economics, and the labor market are utterly central. It's half of our mandate, so we spend a lot of time talking about that. I think there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on, but we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about. Most folks would say now it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials? And could you further elevate those risks with higher still rates, possibly for longer?
So
it's a big question.
I'm trying to think where to start. I'll start with commercial real estate. We're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks, it's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was it was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's do you risk further exacerbating those issues if you get up to another 50 basis points?
So I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes. So we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
Okay, let's do a big summary. We got a lot to cover here. That's a pretty big one. Kind of some frustrations in that one. So let's go through all of this. Quick reminder, expiration of that coupon code's in 2 days. We've got this big screen on screen now showing you all the price increases that are coming over the next 4 phases. And they're all being combined with a massive release of new lectures. So it's really to benefit all the course members, especially the existing course members. Okay, let's get started. Ready for this? Here we go. 5 seconds. Here it is. Wow, I don't know what it was, but today Jerome Powell just seemed extremely frustrated. It felt almost like he was presenting a lie. Now, there could be 2 reasons for why he would be presenting a lie. I'm going to talk about that. We'll talk about the punch card. We'll talk about some of the other important things that were said, including, are we getting a rate cut this year? Hint, no. So first, why did he seem frustrated? My expectation was he seemed frustrated because there are 2 explanations, and I'll tell you which one I think he would lean towards. One, maybe he wanted to hike rates. We got a pause today. Maybe he wanted to hike and he was frustrated that he had to pause. Remember, this was a unanimous decision. That's one possibility. The other possibility was that he wanted to pause and he wanted to be done. Remember what he told us in the prior 2 meetings. He told us that we are at restrictive levels of rates. Today, we signaled a pause, and it almost felt like he had a script. In fact, at one point, he screwed up his script. That was actually quite interesting if you caught it. I'll redo it for you. Basically, he says, hey, a skip gives us a full quarter of data. Oh, the skip. I shouldn't call it a skip. The pause, because skip implies a future rate hike, right? So there are 2 ways to look at it. Either he personally wants to hike today, and he was frustrated with the questions and frustrated with markets because he wanted to hike and he got a pause. I don't believe that, because I actually think other members of the Fed are more hawkish than he is. I think he's the dove. I think he actually wanted to signal that this was it, that rates were restrictive, but the higher powers that be were whispering in his ear, were holding a gun to his head saying, you need to talk this market down. You need to lie to this market and tell them that things are out of control, that core PCE is rising again, and this is a problem. Look at it on a 6-month chart, for example. I'll pull that up in just a moment here so you can see it. In fact, actually here it is on screen now. So the 6 month is bobbing up again. There's that little bob up right there. If you look in the middle of the screen here, this sort of moderate blue level, oh, it's bobbing up again. This isn't falling as quickly as we want. Jerome Powell, tell the world that that's why we're all going to end up having rates go up more. Now, what we did is we had a challenge. We had what I call a 4 punch card challenge to evaluate Jerome Powell today. And the 4 punch cards were, well, 3 of the 4 were answered. One of them was somewhat answered. 3 of the 4 were answered. So here's what our punch card was, okay? And I'll give you the punch card. Oh, let me quickly also finish the thought that with his frustration, just to prove his frustrations to you, if you remember how he acted, his answers were, hey, are there lags? I don't know. Credit tightening? I don't know. Restrictive policy? What level is that? I don't know. Last month, he was pretty dang confident what restrictive was. In fact, he gave us the formula for what restrictive was. Now it's I don't know. Inflation high? I don't know. It's trending a little high. We don't want core to be above 4%. It's too high. Wages going down? I don't know. They might be going down, but I don't know. The whole thing felt really like, rather than him telling us how he truly felt, it felt like he was putting on an act for us. And so I think we can somewhat evaluate his act by considering the 4 punch card that we came up with, the 4-hole punch card. So you ready for this? Number 1, the punch card number 1 that we wrote down was, is he going to distance himself from the dot plot? That was actually a really big deal, the dot plot, because the dot plot came in a lot hotter than we expected. To remind you what the dot plot said, in case you didn't see it live, take a look at this. We were looking at a 5.1 for a Fed hike, we were looking at 5.1 was the last max terminal rate. We were looking for a 5.3 or a 5.4. We got 5.6. That implies 2 more rate hikes. That's not great. We did expect GDP to increase and unemployment to decrease. We got those. We matched my expectation of 4.1% for 2023 unemployment. And we beat my expectation and the previous estimates of real GDP. The recession has basically been priced out. In fact, if you look at the range of estimates here, the negative estimates for a recession are gone. We're not pricing in that recession anymore. However, this 5.6, I think, came as a shock to Jerome Powell. And so one of the punch cards that we wrote down was the following. We said, will Jerome Powell distance himself from the dot plot? And guess what? He did, because I think that number is hawkish. And I think because that number is hawkish, he's saying, hey, you know what? We are going to have to unfortunately recognize that, hey, maybe for some reason, markets need to price in a little bit of a higher rate. Yeah, let's talk the market down. Let's go with that SEP. But I don't buy it. I don't buy it one bit. And I don't think Jerome Powell buys it either. And I think that's why he was coming across as sounding like a lie. So what did he say? Well, he said the following. Well, I can't really talk about the SEP. The other members of the board, here it is. Listen to this quote. They sit around the country in their different offices. They send in their forecast on Friday, and then we submit it. That's what the summary of economic projections is. He did not have to say that. He literally distanced himself from that dot plot as far as you possibly could. He's like, hey, look, that dot plot, man, that doesn't represent my opinion at all. People sit around the country and that's what they send in. Jack, I know they're saying just give him a thumbs up, okay? I gotta concentrate, sir. So the second part of the punch card was that our rates restrictive, and we were trying to evaluate, are rates restrictive? And so Steve Leisman actually answered the question, or asked the right question. He asked, hey, so are we restrictive? Like, this is a very confusing SEP. Again, why Jerome Powell was distancing himself from the SEP, in my opinion, and why it sounded like he was coming across as lying, because I don't think he believes this SEP. I think there's no way in HE double hockey sticks he thinks 2 more rate hikes are here. I could be wrong, but I think that's why he was so frustrated. So when it comes to the restrictive question, he stated that, look, we're much closer to sufficiently restrictive. I think that's sufficiently restrictive is where the risks of over and under doing it are closer in balance. And we do have risks of inflation going to the upside, but the reality is we need more data. And that's the more data part is what we have to talk about, because we have to talk about when would the Fed likely raise rates again. I just quickly want to remind you, link down below, you have courses on building your wealth. Prices will be going up on Friday, June 16th for phase 1 of a 4-part price increase cycle. The reason we're raising these prices is because we're adding a ton more content to various courses here. We're bringing AI to the real estate investing and stocks and psychology and money group and adding more to the productivity group. These are the courses on screen now. See them all linked down below. And I'm using banners now just to simplify the pitch to keep it shorter for you. So continuing, the third thing that we talked about was that is recession still a base case scenario? Previously, he suggested it could be. And here he didn't really give us an answer. In fact, he somewhat implied that a strong labor market that gradually cools could keep us out of recession. He didn't really answer this one directly. I think the summary of economic projections did, but I think it's a little rich to say on one hand, don't look at the summary of economic projections. On the other hand, say, do look at it. So I'm going to say he didn't answer that one. The fourth one he did answer, which is that, yes, wage inflation is gradually trending down. To be consistent with 2% inflation, we need 3% wage increases. 3% wage increases at about 70% for consumers brings you to about 2% for inflation for CPI. It's roughly the background math. Don't worry about it. The point is, he acknowledged that, yes, wages are moving into a more balanced environment. No wage price spiral. No wage price spiral means no Paul Volcker. The really bad potential of this market is not here. And I think that's why even though markets initially moved down, they're already rallying into the close. NVIDIA, for example, is at 425. It went down to 416 during the press conference. Now it's rallying into the close. That could be nuts. But anyway, Intel's moving up at about the similar level, and I'm really bullish on Intel. Forget that for a moment. We don't need to talk about my stocks. I talk about that in different videos. But what I really want you to focus on is that if you want to see this webcam, which accidentally showed my pants or lack thereof during the live stream, make sure you check out metkevin.com/webcam. It's a paid promotion on the channel, metkevin.com/webcam. It's a great device. Really love it. Just make sure you turn off that face tracker when you don't want it. Anyway, okay, so those are the 4 punch cards. Now I'm going to talk about some of the other details that he talked about, but I want to recap some of those 4 punch cards really quickly. I believe, and this is my opinion, make your own opinion. We ran a poll as well. The poll said that out of 5,000 votes, 53% of you thought this was a bullish meeting, 47% of you thought it was bearish. So basically, that's a 50-50 right there, right? So no real clarity on the poll results. But what does Kevin think? Remember, you come here, in my opinion, to get my perspective. I try to give you the non-biased facts and information, and then I want to give you my opinion. So my opinion is Jerome Powell was lying through his teeth that this market is actually going to give us 2 more rate hikes. I think he was lying through his teeth because he had to. He had to send the unanimous message of what the chair or the entire board wanted. I think the board said, listen, Powell, we will give you that pause that you want, but only if you talk this market down, make this market stop rallying, make sure you tell them that inflation is surprising to the upside. You know what? Here, you need a piece of data? Look, what's one piece of data that's slightly negative? Oh, don't look at the 6-month change for PC inflation. Don't look at the 12-month change. Use the 6-month because that's the one that went slightly hot. So talk about how it's going up again and how there's more work to do, and talk about how, you know what? Even though you said rates are restrictive, now we don't know if they're restrictive anymore. And even though we're not looking at a recession anymore, that just means we have more work to do on inflation. And I think that's why he was acting like a fussy jerk during this press conference. He wasn't his dovish usual self. But you know what? There's actually something else that was different about Powell and the statement and his behavior in the press conference. So his behavior in the press conference and the questions, I think, was shaped by the board. But you know what he wrote? There's something that he wrote and he has full responsibility of. And you know what that is? It was the opening statement. And the opening statement was not hawkish. The opening statement was dovish. The FOMC statement was not hawkish. It was neutral. We didn't really get a hawkish pause from Powell. We got a pause from Powell and a hawking board. That's what we got this meeting. So what else did we hear? Well, first, we heard that Jerome Powell suggested they've made no decisions on future meetings. They're at a point now where they're not planning on hiking every meeting, but that they haven't made decisions on future meetings. They really want a full quarter of data, whether he was referring to May, June, July, or he's referring to, please hold on a second, or he's referring to September. I personally think, much like what we saw this morning, the market is starting to price in that the terminal Fed funds rate might actually come in September, not in July. So I think you could get 2 pauses. You get a June pause, you get a July pause, no meeting in August. And maybe if you need to, you hike one more time in September. But this 2 more hikes, I don't see it unless the data really started getting dark. If the data went dark, we'll adjust, we'll flip-flop. But right now, the data is saying stay paused, maybe one more hike. The fact that this SEP suggested 2 more hikes, I think pisses Jerome Powell off. I think he's going home. He's going to ride his bike home, and then he's going to drink a 5th of vodka. That's what I think. I think he's pissed. Yeah, that's a good one, isn't it? Okay, so then we have GDP, obviously stronger, away from recession. That's great. Inflation takes time. There's a lag, a lot of uncertainty, speed of tightening, level of tightening, how long to stay there. We're at the how long to stay there part. Are we going to target housing with more increases? Well, no, we're looking at the broader economy. Commercial real estate, we expect some losses. Oh, this was a good one. Most of the FUDsters are using commercial real estate as a way to say, this market is going to crap. Jerome Powell actually gave us bullishness here. You want to hear what he said? He said, I think the commercial real estate problem will be, quote, around for some time versus some kind of sudden black swan event that essentially crashes the market, right? So will be around for some time versus sudden. That was his line. That's a very big deal. Very big deal. So this is just sort of a gradual decline. Regarding the reverse repos, he acknowledged that the reversal repo facility actually started falling. It started falling, the balance, because the TGA is filling up the Treasury General account. There's plenty of liquidity in the system. The bears are like, but Kevin, China's slowing down. There's a liquidity problem. The Treasury General account needs to be filled back up. PCE, core PCE is running too hot, and we're going to have a wage price spiral. All of these things are crap, and commercial real estate is going to blow up. All of this is crap. None of that, like all of those descriptors, are a great explanation for why we have 5% interest rates. But are they a reason to say the market needs to plummet even further? Absolutely not. Absolutely not. So on the final note here, what do we have? We have hiring rates. Yes, they weigh on hiring. It'll take some time to evaluate. Inflation expectations are still anchored. Okay, so in summary, no rate cut this year. Absolutely inappropriate, says Jerome Powell. He basically lied through his teeth because the board twisted his arm into acting hawkish, but he is not hawkish. He is not hawkish because he is evidencing that he is not hawkish by his opening statement and the fact that he distanced himself from the summary of economic projections, the furthest I've ever seen him distance himself from that SEP, suggesting, people sit around in their offices around the country and then they submit it in. He really distanced himself from the SEP. So I think Powell is on par for pause, wait until September, and maybe keep the pause. If some of these inflation numbers start coming in hot, fine, give us another single hike. But this talk about 2 is going to be something that the hawks are going to pick up on without evidence, and I think they're going to be wrong, unless obviously the data comes in harsh. Remember, I mentioned earlier in this live stream that Elon Musk sees deflation coming. Elon's been a pretty decent leading indicator of, hey, inflation's going to plummet. Hey, deflation is coming. Although he might just be a little bit early, and really is the Fed solely paying attention to Elon Musk? No, absolutely not. So that's what you have. Again, if you want to learn about my courses, go to the links down below. Big price increases coming. The next one is in 2 days, in just 48 hours from now. Email us at staff@meetkevin.com if you have questions. I brought this live stream to you with StreamYard and recorded it with StreamYard. Go to metkevin.com/StreamYard, a paid promotion to learn more about that. You want to see the webcam that accidentally created a crotch shot for Kevin during the live stream, go to metkevin.com/webcam is a free promotion. And if you want to see the software I use to throw up the ticker screen during our live stream, that is Webull. Go to metkevin.com/free, sign up and get yourself 12 free stocks. And with that said, we will see you in the next one. Thank you so very much for being here. Appreciate all of you. Even if you're not a course member yet, I have faith that one day you'll join us there, and I still love you regardless. Hopefully you appreciate all the fundamental analysis we do have in the course member live streams. And folks, we'll see you soon.